Welcome to Libertex. Trading can come with a lot of anxiety if you are not actively mitigating risk and staying true to your trading goals and strategies. To help you get more from the markets and manage risk more effectively, we've put together this video covering the best 7 tips for risk management in trading designed for 2021. Whether you're a short-term trader or investing for years to come, these tips are applicable for strengthening your trading skills in any type of market, be it stocks, forex, crypto, metals, or other asset classes. And if you'd like weekly videos from inside the markets covering the biggest movers and breaking developments from the world of metals like copper, silver, and gold, as well as the top crypto movers and stocks and trading strategies, consider supporting us by liking this video and subscribing to our channel to join our growing community of traders and investors. So without further ado, let's jump into the 7 most essential trading tips to manage trading risk. It goes without saying that the markets can be volatile, and there are a lot of factors that determine whether it's a good time to put more money into the market or whether it's advantageous to wait and collect more research. Our first and perhaps most important trading tip to offset and lower risk is to never trade money you cannot afford to lose or are not comfortable with losing. Before entering a trade or investment, determine how much money you can lose without having it deeply affect you. Losing sleep and focus because of your trades is something that will not benefit you, so taking large positions is only advisable if you can stomach the prospect of losing the money or feeling okay when and if the asset falls in value, potentially going to levels much lower than where you bought in at. Studies have shown that an advisable trading amount would be no more than 2% of one's brokerage account balance. So, repeat the mantra, never trade with money you cannot afford to lose. Our second tip to minimize risk in the markets is to be well diversified. It's never advisable to put all your capital into a single asset, stock, cryptocurrency, or other tradable instrument. Instead, spread your money out across different markets and sectors, with perhaps a portion going to cryptocurrency, a portion going to growth stocks, a portion going to blue chip stocks, etc. That way, if there is a big drop in one asset, the potential for loss can be offset by other areas of the market that are performing well or even extremely well. Going all in with speculative YOLOs leads to painful losses more than it does profits, and traders can be left holding the bag for up to years, waiting for the asset to recover or make the difficult decision to cut losses with a harsh lesson learned. This brings us to our third trading tip, which is knowing how and when to cut losses. From a technical standpoint, traders do not experience losses until they sell the asset for a price lower than where they bought in at. As a rule of thumb then, it's essential to have a strategy in place for how to handle this type of situation when areas of your portfolio are in the red. The most logical thing to do is not to panic. Assess whether the drop in price can be attributed to anything out of the ordinary, and if so, how significant of an impact it will have on the asset, and whether or not you are willing to wait for it to recover. If you are investing in assets with long-term prospects of anywhere between 3 to 5 years or more, go over your thesis about the asset and why this could just be a case of market manipulation or a market-wide correction. The markets go up and down and rarely stay in one direction for very long. If, after assessing the damage, you feel absolutely certain that the asset will not recover, then consider cutting losses. To avoid making this painful decision, however, we can now go into our fourth trading tip. Set stop losses on risky trades. Before entering the markets, make sure that you know how to set up what's known as a stop loss in your brokerage account. A stop loss will allow you to exit out of a trade if the trade drops to a certain level that you define. Therefore, in case of catastrophe, you can get out with a healthy amount of your capital remaining intact and avoid the potential for serious losses. It's advisable to look at the nearest levels of support on an asset and place stop losses around those areas so you can get out of a trade at a minimal loss if it starts falling to the downside. Our fifth trading tip to minimize risk in the markets is to know when to take profits. The goal of trading is to make money, so when you are considering entering a trade, set realistic goals about what levels you would be satisfied with selling at. Whether it's 10, 20, or 30%, the golden saying is that profit is profit no matter how much. Therefore, if you see an asset is up over 50%, review if there is a considerable case for the run-up and whether or not it can be sustained. If not, consider selling and taking your percentage of gains. Being greedy and not selling when an asset has gone through a considerable rally can severely increase the amount of risk considerably. If you sell an asset when it's up and then it comes back down, you can always consider getting back into the trade if you still believe it will recover to the previous levels or higher. Similar to setting stop losses, with Libertex you can also set take profit levels so that you can exit trades after a healthy run-up without second-guessing yourself or experiencing the temptation of greed. Moving on to our sixth trading tip, limit your exposure to leverage. Leverage can be a great tool for experienced traders as it can multiply results. This is a double-edged sword, however, as if you have a 10x leverage, for example, while it's true you can 10x your gains, you can also 10x your losses. Leverage therefore exponentially increases risk and is not advisable if the goal is to minimize risk and implement a responsible and sustainable trading strategy. For the most part, this has a lot to do with avoiding temptation and staying true to your core trading strategy. Our seventh and final trading tip is to buy when assets are low. The fear of missing out is often experienced when an asset is trading up massively from where it was only days before, but it's often a mistake to enter at these times. When an asset has gone up by a significant amount, there is almost always a cool-off period or pullback. As traders, timing can be one of the most important things, so buying when the asset is near its all-time highs is not a good approach. Instead, traders should seek out more opportunities to buy when assets are in the red, to buy as close to the bottom as possible, so that when the asset recovers or goes on its next rally, you can be a part of the full ride while experiencing less risk because you bought in when it was on sale, so to speak. Do you have any trading tips of your own that you follow? Let us know about some of your worst mistakes and biggest wins in the market, and consider opening up a free account at Libertex.com or via the links in the description below for a better trading platform equipped with market signals and all of the tools used by the pros. We hope these 7 risk-related tips help you get more out of your trades this year. And if you like this video, don't forget to hit those like and subscribe buttons. Thanks for watching, and see you next time.